Ok. Então, estamos ao vivo agora, estamos entrando ao vivo. Vamos guardar só mais um minutinho para iniciarmos exatamente no horário. Ok. Vamos lá, então. Bom, boa tarde a todos. Meu nome é Alessandro Nebasso, professor da Universidade Federal do Rio Grande do Sul. E a gente dá prosseguimento à série de debates que a gente está promovendo em uma parceria entre a Universidade Federal do Rio Grande do Sul e a PUCRS, relativo à economia no contexto da pandemia. Essa série de debates é uma promoção da Faculdade de Ciências Econômicas, através do Instituto de Estudos e Pesquisas Econômicas e o Programa de Pós-Graduação em Economia, e da Pontifícia Universidade Católica do Rio Grande do Sul, via Escola de Negócios e o Programa de Pós-Graduação em Economia da PUC. Nessa tarde, a gente tem o privilégio de ter conosco Michael Roberts, economista britânico, autor de vários livros, e que publica regularmente no seu blog The Next Recession. Ele vai estar conversando essa tarde com Adalmir Marquetti, professor do Programa de Pós-Graduação de Economia da PUC, e Marcelo Milan, professor do Programa de Pós-Graduação em Estudos Estratégicos da UFRGS, e professor da Faculdade de Ciências Econômicas. A nossa dinâmica será a seguinte: eu vou passar inicialmente a palavra para o Adalmir Marquetti, ele vai fazer as apresentações, falar um pouquinho do trabalho de Michael Roberts. Michael Roberts irá apresentar, fazer sua discussão ao longo desse período. Na sequência, tanto o Adalmir quanto o Marcelo Milan vão fazer algumas questões, depois o Michael Roberts continuará uma segunda rodada de reflexões, e ao final a gente temos questões. Eu estarei acompanhando as falas no YouTube, e questões vocês possam colocar no chat, serão submetidas a Michael Roberts no final da apresentação. Eu agradeço muito e lembro que a palestra vai ser em língua inglesa, e eu passo agora a palavra para o Adalmir Marquetti. Desejo a todos nós uma ótima atividade nessa tarde.
Bom, eu vou começar falando em português, né? Agradecendo a audiência, agradecendo a presença do Michael Roberts e a presença do professor Marcelo Milan, da UFRGS. É uma grande alegria poder contar com a presença do Michael aqui com a gente, né? O Michael tem escrito textos na tradição marxista e trabalhos, livros, publicados artigos, né? E mantido o seu blog, né? The Next Recession, que tem chamado a atenção internacional. O blog do Michael, né, chama a atenção pela qualidade das suas análises e pela profundidade das análises e pela quantidade de material que ele produz, né? Tem sido mundialmente, talvez seja o blog marxista mais conhecido em todo o mundo, e, portanto, tem feito um trabalho muito importante, né, de análise da economia capitalista, de divulgação do pensamento heterodoxo, crítico, marxista, em todo o mundo, né? Agora eu vou começar a falar em português, né? Gostaria de passar inicialmente a palavra para o Marcelo também se manifestar, e a seguir a gente inicia o nosso debate se passa a palavra para o Michael.
Então, gostaria de agradecer aí o convite, né, do professor Adalmir, professor Alessandro. É uma honra também participar aqui desse evento com Michael Roberts, como o Adalmir já colocou, né, é um dos principais, né, formuladores de interpretações, né, da economia atual, né, tem um blog bastante instigante, com muitas informações, muitos dados, né, um leitor bastante atento, principalmente das publicações aí, né, das instituições financeiras, das instituições de pesquisa, né. Então, é um pesquisador que acompanha bastante o que está acontecendo, né, e tem uma habilidade muito grande em digerir esses dados empíricos e transmitir, né, isso de uma forma bastante intuitiva e fácil de se acompanhar, de se entender, mesmo que tenha por trás, né, uma interpretação teórica bem profunda e bem rigorosa, né. Então, gostaria de agradecer ao convite, né, novamente, e desejo a todos e a todas um ótimo evento aí com um dos principais, né, formuladores contemporâneos de interpretações marxistas da economia moderna.
now I was talking in English. Let's talk in English now. Michael, we introduce you for the Brazilian audience. It's a great honor to have you with us. It's great that we accept our invitation. We are very happy that you said yes to us. It's a great honor to be here. And now we listen to you. And then after your talk, you ask some questions, and we also ask questions of the audience. You turn off my camera, so then and give so that you can talk.
Well, I don't know if you can see me enough. I hope so. Thanks very much for everybody inviting me to make this presentation on the pandemic. More recently, I had Professor Marquetti interviewed by me about the situation in Brazil, the capitalism and the COVID there. And I do recommend anybody who's watching now to take an opportunity and go to my YouTube site to see the interview I had with Adalmir Marquetti about Brazil, because I think it really does cover a lot of ground about the history of Brazilian capitalism and the current situation. But today I want to deal with the global position, as far as I see it, and in particular in three sections: what the state of the world economy was before the pandemic hit, what has been the impact of the pandemic on the world economy, and then finally perhaps to look at what will happen now as many countries begin falteringly and failingly, in many cases, to come out of the lockdowns which have taken place over the last since the beginning of the year and a bit later, and to see where the world economy is going to go and capitalism is going to go in this period in the post-pandemic economy. To do that, I've got quite a few graphs, so I'll just see if I can link those up for you now. I'm looking for the share button down here. We go. So I'll just click on that and we'll get. There we go. Okay, so we're going to talk about the pre-pandemic economy first, and then we'll move on, as it were, through the timescale. The first thing I want to bring to your attention is that we have been entering what you might call a depression for the last 10 years before we even got to the pandemic. What do I mean by a depression? Because that sounds very serious. Well, I mean something similar in many ways to what happened in the 1930s, where you got a significant decline in the growth rates, employment, and incomes for the majority of the population, at least in the major economies in the 1930s, but now affecting most economies around the world as we've globalized over the last 50 years. This is a little graph out of my book, The Long Depression, and you can see what I'm arguing here is that for the last period, 10 years in particular, the world economy has been depressed in the sense that if you look at the left-hand corner, you can see recessions take normally this form under capitalism. You're going at 2 or 3 or 4% growth, then you have a sharp slump, as in 1974-5, then you recover and the trajectory continues. Sometimes, as in the 1980-82 slump, you have what is called a double dip recession. So it goes up, comes back, goes up, and then back to trend. But a depression is when you drop into the recession, the slump, but you do not return to the original trend growth rate. And that's the situation that's happened in the period since 2008-9 and the Great Recession was over. So you get a sign, if you like, of a reverse square root sign rather than a V shape or a W shape. And that's the sort of economy that the world, at least the major economies, have been suffering. The US has had, in this last 10 years and more, the longest economic expansion on record. It's been continual growth without any recessions for nearly 11 years. That has not been met in the post-war period in the United States in terms of the number of months. But it is the weakest growth rate that we've ever seen in terms of recovery after a major slump. And if you look at the major sectors of the world economy, you can see that growth rates were already slowing a little bit after 2000, but they particularly began to fall after the Great Recession. So the average growth rate, the long-term growth rate in the economies, the 10-year or a 6-year rolling growth rate, for most economies, the leading economies, was slowing down to 1%, or in the case of Japan, under 1%, in the case of Europe, down towards 1%, in the case of the US, down towards 2%, and even China was slowing down to those sorts of levels, about 5 or 6%. So the world economy was already slowing down before we got to the COVID. And if you look here on this chart on the left-hand side, you can see the black line shows the trajectory of growth before 2000. That was the pace of growth in terms of dollars per capita. And then you can see the gray line. That's what happened after 2001. The growth rate slowed significantly. And then when we get to after the Great Recession, we begin to see a growth rate which is even lower than that, the blue line. That's the actual growth rate in the US per head in terms of the index on the right-hand side. And you can see things have slowed quite significantly in the period since 2008-9. And that's revealed also by the graph on the left, on the right, sorry, which shows the change in the trajectory quite sharply from the trend growth rate that existed over the last 40 years up to 2007, and then what actually happened after 2008-9. And Goldman Sachs's forecast for the COVID, which I'll come back later, shows a drop which will take us back to levels in the US per capita that we've not seen since the early 2000s, and certainly before the Great Recession. So why is this? Why have we had this very slow growth and reduced economy entirely? Well, the reason is, first of all, that productive investment growth rates have gone down hugely. The actual productive investment as a percentage of GDP in most OECD economies has declined sharply. This is the net investment. So after investment to replace exhausted or depreciated capital has been replaced, how much extra productive investment has taken place on average as a percentage of GDP. As you can see, back at the end of the 20th century, the growth rate was something like 6 to 7% in terms of percentage of GDP. Whoops. But that slipped away to around 2 or 3%, and probably with the COVID, we're going into negative territory for the first time. So investment will not even keep up with the depreciation and exhausting of existing investment. And that's an indication of how weak the economies before the pandemic were globally, particularly in the major economies. And here is a measure from the Penn World Tables, which has a new series which looks at the internal rate of return on capital stock. And it's a very good proxy for the rate of profit in most of the economies around the world. And you can see that here I've calculated what the rate of profit is for the top 20 economies, the G20. Strictly speaking, that's 19 economies, because the EU is the 20th member of the G20. And you can see the rate of profit has deteriorated from the peak after the neoliberal period in 1998, and it's been going downwards, but a sharp drop from 2008-9 with the end of with the Great Recession, and there's been no real recovery in the rate of profit for capital stock on average for the G20 economies, and we're now at levels very close to the lows we saw in the 1980s after the great profitability recession, which affected most economies. So investment growth has been weak, investment has been weak, and that's because profitability has been weak. Here is I took a selected group of the emerging economies, so-called, in the G20, and you get an average like this, pretty much the same thing, with the emerging economies' rate of profit also declining, particularly after the period of 2008-9. And just for fun, if you want, I looked at the Brazilian rate of profit. Adalmir is an expert on this subject, but you can see that according to the Penn World Tables, we get a similar decline, particularly after the end of the commodity price boom in 2010. But generally, the profitability of capital stock in the major capitalist economies, in both the advanced economies and in the so-called developing economies, has reached lows. And in the periods of the last 10 years, there's been no particular recovery, which makes it very difficult to see an expansion of growth, employment, and investment, and therefore incomes as well. If you want to, seems odd or contradictory, because often you read in the newspapers and the financial papers of the massive profits being made by the huge companies, and the massive profits have been made in COVID now by companies like Amazon, Google, Netflix, Microsoft, so on, Facebook, huge profits. But actually, that's exactly it. The huge profits that these companies are making is the exception. If you look at the left-hand graph here, you can see that the world earnings for technology stocks, like the FANGs as they're called, has rocketed up since the end of the Great Recession in 2009. But the profitability of all the other sectors in earnings terms here around the world has hardly moved at all. It's more or less flat. That's total earnings or profits, not profitability, but total earnings profits have not moved much at all in even nominal terms on that figure. If you look on the right-hand side, you can see the US is the place where profits have moved up most. So people always look at the US and say, well, our profits are doing very well. Europe hasn't done well at all. But if you strip out IT for both the technical sector, you can see that the improvement in margins is very limited in case both European and US economies. Profits have not expanded for the vast majority of companies around the world, and therefore profitabilities continue to fall. And in particular, for the very small companies, the weaker companies, what you've got is a sharp increase in the number of companies who only just get enough profit to cover the interest or debt servicing costs on the debts that they've run up. Companies that just cover the profit on their debt servicing have been called zombie companies. They're living dead. They are not progressing. They're not investing. They're not expanding. They're just surviving. And the number of these companies, particularly among small companies, has reached something like 20% in the American economy. And that also applies to Europe as well. So this is a very weak period before the COVID. Before we even get to the COVID, you can see the nature of the weakness of capitalism over the last 10 years. And in particular, of course, in order to overcome that and to get any sort of growth, what we've seen with low profits, low profitability, and flat profits for the majority of companies, we've seen a huge increase in corporate debt. Interest rates have fallen sharply over the last 10 years, almost to zero. So a lot of corporates can make issuance for bonds or get loans from the banks at very low interest rates. And as a result, they've been able to survive by expanding their debt levels to keep their businesses going. And you see a very sharp rise in corporate debt as a share of GDP, both not only for mature markets, but also for the emerging markets as well. And the world GDP debt ratio has reached record post-war record levels. That's kept many companies going, but has also created the conditions for which made it difficult to expand in productive areas and take the capitalist economies forward and improve the conditions and the profitability of those companies when they have all this debt still to cover. Here's a little graph that I did, which measures the amount of GDP for every unit of the debt that is introduced. So as you can see, back in 1993, for every single unit of growth in debt, you would get an increase in growth in GDP, which is quite considerable, something like 6 to 7%. But now, for every extra unit of debt in GDP terms, it's actually negative. So the corporates are expanding their debt, but they're not delivering any increase in productivity as a result of that. So this is a very difficult situation for capitalism, all this before the COVID hits. One of the big features of the period since 2008-9 has been the sharp fall in the growth of world trade. As you can see in this graph, before the Great Recession of 2008-9, average growth world trade growth was nearly 6% over that period between 2001 and 7. And that's way higher even than the emerging market average growth rate in GDP, which is about 4 or 5%, and certainly for world GDP growth. So trade was a way in which many countries who don't have much domestic possibilities could expand globally. That's particularly the case with emerging economies relying on export-oriented way of expanding production and sales. But since the end of the Great Recession, the average growth in world trade has dropped dramatically to just 2% a year up to 2019, 1/3 of what it was before, and actually below now, or no higher than average world GDP growth. So world trade is no longer an escape mechanism for many economies that don't have much domestic market or expansion. And you could argue that in many ways this shows that globalization is over. If you look on the right-hand scale, you can see the massive expansion in the trade openness index. That's the amount of trade as a percentage of GDP on the world scale for most economies. But that came to an end after the Great Recession. It's flattened out. And of course, this is the reason why we have the intense level of trade rivalry now, which is beginning to appear. This happened, the battle between the US and China and other countries over trade, and Trump's program of trade protection took place before the COVID. This was taking place for the last 2 years now. And that's a product of the fact that trade is no longer a place in which you can expect everybody to gain. It's now become a battlefield to get the share out of it. And finally, on the first section, we can see this is a measure of the corporate profits in the major economies, the global corporate profits, if you like. I've got 5 or 6 major economies. I've weighted their corporate profit growth rates, and you can see before we get to the COVID 2019, the growth rate in global corporate profits had ground to a halt. So that includes everybody, the techs and everybody in the major economies. And yet here we have no possibility of growth in profits. And in my view, profits is the driver of accumulation and investment under capitalism, particularly productive investment. And if you've got zero corporate profits and you're moving into negative territory, then you're more likely to end up with an investment and then a full all-out recession. And you can see the dips below zero there coincide with the slumps that we've seen over the previous 20 or 30 years. And then we had the pandemic and the lockdown. And I'd like to point out that that pandemic and the lockdown produced not just, you could say it was a unique event, both in its intensity, but also in the way it operated, because it starts with a supply shock, a closure down of all the work, of production. So the shock is in production to begin with, and then in investment and employment and in spending. Actually, that's how capitalist crises take place. They start with a stopping of investment, then production, employment, and spending, contrary to the Keynesian view, who say it's the other way around. In fact, we start with a collapsed investment in most capitalist crises, maybe coinciding with the financial crisis, but not always. And in this case, we started with a collapse in production, which then led to the closure, the lockdown, the closure of investment and employment, and people being laid off or furloughed or sent home and so on. But the supply shock obviously went on to the demand shock, loads of the companies closing down, workers not sure they were going to get enough income, and so we had a dramatic reduction in consumption, particularly in areas where people needed to travel or to do leisure consumption. All those demand collapsed. What we haven't had yet is a financial shock, and that's still a possibility over the next year or two, as we see how many companies, as I'll come to, get into difficulty as a result of the supply and the demand shock. On the right-hand side of this diagram, you can see that the reaction to the supply shock is to introduce fiscal spending. The reaction to the demand shock is to introduce monetary action on the part of the authorities. How effective that will be, we can discuss. But what we can see is that the global economy, from the beginning of 2020, went down over a cliff, both the advanced economies and the emerging economies. We've never seen anything quite as severe as the slump in production, demand, and employment, which has taken place during the first 6 months of this COVID pandemic in 2020. This is, to use the word unprecedented, that's the common word in the newspapers, and it's certainly true. Nearly 90% of the world countries are in recession now in 2020. There's never been anything like that. Not even in the 1930s did we get that level of percentage of economies in recession. Of course, the argument is it will only be short-lived, but that's what we will discuss in a moment. But nevertheless, even after 6 months, we have had the biggest drop in production and employment and income for the largest number of economies around the world in an unprecedented level. Employment in most economies, according to the International Monetary Fund, has been fallen by something like 15 to 45%, depending on the country. You can see in the case of Brazil there on the right-hand side, the drop in employment, which has taken place. Most developing economies, the vast majority of people are in what's called informal employment. They don't get wage and salary docs, they're paid in cash, or they're on casual labor or contracts and so on. And of course, their employment has just disappeared dramatically as a result. So many of the developing economies have taken the biggest hit in employment and as a result in incomes, and it's still going on. While the more organized and formal economies like Japan, where the COVID has also been less damaging, have not suffered so much. You can take that diagram as an indication of those countries, at least up until June, who have suffered less on the left-hand side and the most on the right-hand side from employment. Here's the latest figures for US unemployment claims. It's up around 30 million in total for continued unemployment claims. Given that the workforce in the US is about 130 million, I'll leave you to work that out, but it's something like 20 to 25% of workers in the US are now claiming unemployment, plus others who are on various schemes which keep them off the unemployment list. All of those schemes, by the way, which the administration has introduced, will be ending at the end of August. And as I say, emerging economies have been hit the most. For the first time since 1960, or since reliable records began, it's estimated that the emerging economies will have a contraction of GDP on average for all of them as a group in 2020. That's for the first time. And that includes India, and that includes China, that includes the faster growing developing economies, as well as all the others. So that again is a staggering indication of how deep this pandemic has caught and the lockdown that's come with it. Now, what have authorities been doing to avoid the impact upon households and upon companies as a result of that? Well, the biggest indication of that is the huge injection of monetary and credit packages by the Federal Reserve or by the governments backed by central banks, providing the funding through the printing of money or through the buying of corporate bonds, treasury bonds, government bonds across the world, in order to, from the banks and from the institutions that hold them, in order to inject money and credit into the system. In the case of the Federal Reserve, there's been a sharp increase in the Federal Reserve's total assets. It'll probably hit something like 40 to 50% of GDP by the time they're finished. But what has been the result of that? Has it? It's kept companies going, but it's also really just been plowed in by companies into more stock market speculation. It's inspired investors to go back into the stock market. So what we see is a dramatic increase in stock market prices rather than any improvement in the conditions of the companies which have been receiving these credit rejections, particularly the small ones. It's estimated in the case of the US that of all the monetary and credit injections and fiscal injections carried out by the administration and the Federal Reserve, that 2/3 have gone to companies, and of that 2/3, most of it to larger companies rather than small ones, and only 1/3 to households in helping them out with their incomes while they're furloughed or being made unemployed. So the generosity has been in the direction of the stock market and the big companies. Nevertheless, this has been the biggest fiscal spending by governments across the world that we've ever seen in history. On average, something like 4.5% to 5% of GDP has been injected through fiscal spending from government spending over and above revenues by borrowing into their own domestic economies. 4 to 5% of GDP is something like double what it was in the Great Recession. So that's an indication of how big it is. And of course, some countries have made huge increases in fiscal packages where they've been bailing out workers and companies, particularly towards, you can see on the left-hand scale there. I'll let you search for Brazil. I'm not sure it's down there, but it's not very high. And here is an indication by McKinsey Group that reckons that the cumulative deficit from all these fiscal spending and injections will be something like 25 to 30 trillion by the time we're finished at the end of 2023, equivalent to 30% of global GDP in the total amount of fiscal gap. In other words, the difference between spending by governments and the revenues that they're receiving, cumulative over the next 3 years, will be up to 30% of GDP. That's a huge increase in spending that either has to be financed by something, being financed by borrowing, which means either borrowing directly from the central bank through monetary financing, or by issuing government bonds for purchases by households and by institutions in order to provide the funds to meet these things. And as a result of that, the International Monetary Fund reckons that by the time the COVID's over, we will have a public sector debt which has exceeded the world war debt globally that reached in the end of World War II in the advanced economies, and of course the emerging economies will also see something higher. Something like 130% of GDP on average, the global public debt will reach. Now, I can remember 4 or 5 years ago, or even longer, after the Great Recession, there was a lot of discussion amongst economists about the dangers of letting public debt get above 90% of GDP. Any country that did that was liable to get some sort of financial crisis as bond yields rocketed and governments found themselves in difficulty. Well, we're all going to hit now something like 130% of GDP. We shall see whether that has any validity as an argument as we progress post-pandemic. What we certainly can say is, even if interest rates remain incredibly low, which they do at the moment, the sheer size of the debt to GDP for the public sector means that the interest amounts that have to be paid, if they're going to be paid by meeting bondholders' interest, even if it's virtually zero, over the period of 4, 5, 6, 7 years, depending on the maturity of US Treasury or other Treasury or government debt, then there's going to be interest costs, and that's going to rise. According to the IMF, it will rise to something like 10% of the tax revenues, which eats into the ability of governments to continue to do the public services which governments are designed to deliver when 10% of all revenues are disappearing in interest for previous debt driven up. So even if interest rates stay low, this is a constriction upon the public sector's ability to help and service the population or even other businesses. And the real danger is, as we go, if this COVID continues, is loads of companies are not going to come back. They're already going bust. They're not able to meet their debt servicing costs, those zombie companies and others, and a whole range of companies, particularly travel, leisure, transport, entertainment, and even in other areas where in the retail sector, we are seeing a dramatic number of bankruptcies begin to rise. If you look at this US figure, the dark blue line tells you the number of US companies that have gone bankrupt already in the first 6 months. That's always adds up to the level of the Great Recession. What's different is, if you look at the grey bars, is that the amount of losses in liabilities in the bankruptcies is relatively lower than it was in the Great Recession, because these are lots of small companies who didn't have, in total value terms, a lot of liabilities. There's just a lot of them who was going bust, rather than the too big to fail banks that we had in the Great Recession, like Lehman Brothers. But that could change over the next year. And so what is going to happen now as we come out of the pandemic? The first thing to say is that there is going to be a permanent loss of output throughout the world. If we have this position, as the IMF says here, the original trajectory of growth, in 2020, their forecast at the beginning of the year. Now they're forecasting June 2020 is that bottom line. The cumulative output loss before they can get back to where they were at the previous level is something like $12.5 trillion, assuming that they can get back to that level over the next few years. And that is lost forever. I think people have to be aware of that. A V-shaped recovery, it still means a permanent loss in that gap between the V. And if it's a much more serious, longer, slower recovery, then the cumulative loss is even greater. And that's lost forever. Jobs lost, income lost, output lost, all lost forever, cannot be returned. An example of what happens in most capitalist slumps is that it's wasted when they're producing and it's wasted when there's the slump. It's lost forever. That could have gone to help people and their incomes and their jobs. So why do I think there'll be no V-shape? First of all, 90% of economies are still contracting, and that's synchronized together. So it means that trade and other things and capital flows are linked together, making it very difficult for a synchronized recovery because of the synchronized contraction. So it won't lead to a powerful, sustained recovery that we see in other slumps. And as I say, the world trade volume is taking place at a very low level. So even if a country starts to recover, like China is now in positive territory in the second quarter of 2020, but it's going to find it very difficult to grow fast back to its previous level because everybody else remains contracting, so there's nobody to sell their exports to, leaving aside the problem of rivalry. And as I say, productive investment per head is dramatically low, as is profitability. Those are key factors in making it difficult for recovery. And we're now in a period where per capita GDP has got the worst decline we've ever seen. This is going to have lasting destruction upon the economy in its wealth and income, which will take time to repair. And as I say, the huge levels of debt which are built up, not just in the public sector, but also in the private sector, which have to be serviced or written off, is going to make it very difficult for productive resources to get any sort of support to increase sustained growth. And the pandemic is not over. This is the latest figure from today, where we can see, yes, Europe or China may be more or less under control, but other countries, the number of infections is dramatically increasing on a daily basis at the moment. Might say deaths aren't increasing so fast, but the cases of infection are increasing, and the higher and quicker it spreads across the world, the more deaths there will be, and the more need there will be for social distancing, control, possibly even lockdowns on a local or national level, which will continue to kill the economy. So with the pandemic not over, no vaccine in sight yet, for at least this year, then the difficulties remain for the second half of this year. So much more likely we get this sort of trade level. Here is, as I said before, the trade reduction that's taken place before 2008. It was that dotted blue line there going upwards. That was trade growth. And then we get to the period from the end of the Great Recession to 2018. There's the yellow dotted line that's hidden there. And then we have three possibilities now in this pandemic and afterwards. The merchandise trade will, on an optimistic level, the green line, make some sort of limited recovery, but it could be way worse than that. So that we're on an incredibly low trajectory for world trade, which is really damaging, particularly for the developing economies. And the IMF did a recent analysis of previous recessions and recoveries after them. It concluded that over a long-term basis, it's quite often the case that you don't get the V-shaped recession you see at the top line up there, where you return to the initial trend line, but actually you stay below that trend forever after the recovery begins, into what you can call permanent economic scarring. The economy is scarred in productivity, investment, and companies' financial viability and so on. So it is unlikely, in my view, that the destruction of capitalist sectors in this COVID pandemic slump will lead to some sort of creative destruction. Joseph Schumpeter was famed for the view that slumps kill off inefficient firms and allow smaller, innovative firms to recover, and that's what sets economies back on a new, higher growth rate. Marx had something similar, arguing that slumps kill off the weak and the lower profitability, and the more efficient and often larger companies are able to consolidate and take advantage of the gaps. But if the central banks are keeping all these zombie companies going by buying their corporate bonds, and this continues for some time, it's more likely that we will end up with a load of inefficient, uninnovative firms and a continual level of zombie companies. So we don't get Schumpeter's creative destruction or even Marx's more serious capitalist creative destruction from this. We will end up with another leg of long repression. You can see this argument here. Again, this is from the OECD, which if we have a double hit of a second a COVID pandemic, or even if we don't, you can see the trajectory means that we don't return to anything like the level that we had at the end of 2019. A very, very slow recovery is ahead. Now, just yesterday, I think it was, or the day before yesterday, UN General Secretary Antonio Guterres made the point that we're at a major point of breaking point for the world economy. He said he likened it to a fragile skeleton of societies, fractured all over the place. It's exposing the fallacies and falsehoods which people are arguing. It's a lie. This is what the UN Secretary General says. It's a lie that free markets can deliver a health system that's robust. It's a fiction that unpaid care work is not important and essential to our economy. It's a delusion that we live in a non-racist society and an unequal one. This is a delusion. It's a myth that we're all in the same boat. We're not all in the same boat. We have an economy which has all those things wrong with it, he says. It's exposed by the COVID. It's time for global leaders to do something about it, to right the wrongs of the past and move forward together for all. Of course, there is no possibility of that, but that's even the UN Secretary General is prepared to make that mark. And I would say, looking ahead, these are the issues facing world capitalism now. COVID on the left-hand corner, yes, it's a big issue, but the recession which is created is an even bigger one, and the damage it's done, which I've covered. And yet there are things still unresolved. The climate change, carbon emissions have fallen during the slump, but they're coming back fast, where no attempt is being made to meet the Paris targets of controlling global warming. Fossil fuel companies are still expanding. There's no attempt to deal with them. And there's been no attempt really to deal with how we got into a COVID pandemic in the first place, which is the collapse of biodiversity, the spread of pathogens from wild animals into farm animals and then onto humans through the industrialization, logging and other methods which are spread across the world without any control for the ecology. That's the future of capitalism in that way. We can see here that inequality continues to rise dramatically. Nothing has been done about dealing with this issue. Rising inequality, poverty, according to the special rapporteur from the UN, even before the pandemic, nearly 1 billion people were earning less than £55.50 a day, and there's been no improvement in profitability on that level for the last 30 years. And that's a serious indictment of capitalism. Global warming, we have a 1 in 5 chance that temperatures will be above the levels of the Paris Agreement of 1.5 improved industrial times in the next years or so. Industrial production, destruction and pandemics continue. And then, of course, we have the growing aftermath of the trade rivalry, which is now with the US trying to blame China for the pandemic, using it as an excuse to take further measures against China on technology and probably on finance to try and strangle China's growing rivalry to US imperialism. I'd like to think we are resetting in the economy, but it doesn't appear that to be the case. We should have a global plan for full employment with jobs at a living wage and pensions which at least 2/3 of that wage. We need public investment in the infrastructure and health, education, housing and transport. And we could move, if we had that sort of investment put there, to a robust health system which will be free at the point of use. And yet we do have nothing like that for the vast majority of countries around the world. We need investment that's harmony with nature, The fossil fuel industry must be phased out. And we need to cancel the debts of the poorest countries in the world and remove the oppression of multinationals and their exploitation of those countries in the imperialist countries. Ending the tax havens of the rich and the powerful, and introducing a proper progressive taxation system to reduce inequality. And above all, perhaps, as a basis of that, to have public ownership of the major financial institutions and multinationals so that we can plan the world in a democratic basis for social need over profit. Of course, that's an objective that we might stand for. The chances of that over the next 10 years on what is being offered by capitalism is nothing like that at all. And that's me.
Thanks a lot. It was a great talk, Michael. I really appreciate it. There are a lot of questions, a lot of interesting points that you raised in your talk. Marcelo would like to ask something for Michael.
Yeah, I have a couple of questions, so I think that we can have one at a time. So the first question for Michael is about this transition between the pre-pandemics and the after in the post-pandemics. You mentioned a shock, right? So you showed an economy in a very bad shape, investment declining, exports stagnating, imports stagnating, international trade stagnated. And then we have the pandemics seen as a shock. How do you put these two things together? A situation in which we have a trend that is already bad, and then something that is not expected, such as the coronavirus happens. And then how can we make sense of this idea of a shock? So we are considering an economy that, okay, is showing a trend of decline and stagnation. And then suddenly we have a shock. But then the shock, it seems that is something that is exogenous, that is not part of the working of the economy. So I would like you to elaborate a little bit more about this transition between these two periods that you showed.
Well, Marcelo, you're absolutely right. I use the word shock because mainstream economics likes to use the word shock. They like to argue that capitalist economy is harmoniously growing. Yes, it has problems, but on the whole, it's stable and moves forward on a reasonably harmonious trajectory. Occasionally, things hit it from the side when it's not looking, and then we have to correct that. But on the whole, it's returning to the equilibrium and continuing the equilibrium path of growth. But of course, that is nonsense. That the capitalism doesn't move that. It moves in a disruptive, cyclical, boom and slump way with inequalities and uneven development throughout its history. And it enters all sorts of regular and recurring slumps. So it's probably the wrong word to use shock. I use that because I wanted to emphasize the three parts of this pandemic, which is the supply collapse, the demand collapse, and the possible financial crash that can happen. In the case of the Great Recession, you might say it was the other way around. We had the financial collapse and it led then to the supply and demand collapse. Of course, underlying both periods was a very weak capitalist economy, particularly on the level of profitability. In the crate of the Great Recession, there was a fall in profitability at least 18 months before the slump came and the global financial crash, and profits actually went negative before that. People don't know that, but that's what happened. So the productive forces, productive sectors of the economy are already weak in the 2007-2008 one, which led to the credit crisis. And this is the argument I'm presenting now, that the pre-pandemic economies were also weak. But it also wasn't a shock in another sense, that the COVID and the coronavirus was not unexpected. For many years now, epidemiologists and virologists have been saying there's a real danger we're going to have pandemics coming from new pathogens which will affect the human beings over the last 15 or 20 years because of the huge expansion of urbanization, industrialization, fossil fuel production and exploration, logging, mineral exploration throughout the world. So the wild parts of the world are increasingly coming into contact with industrialization and human beings. These wild parts, we now know apparently according to the ecologists, bats and other wild animals have got pathogens in them that are dangerous to humans for thousands of years. They generally don't affect bats very much, but these bats have spread their pathogens into farm animals, and industrialized farming has led to the connection between that and into markets in towns and cities, not just wildlife markets, which is supposedly where it started in Wuhan, China, but also into general markets, and humans are picking up. They're transmitting into human bodies, and of course humans are not immune to these pathogens, so they are serious blows. So the UN has had a pandemic monitoring unit for the last 20 years, and only last September it said to the governments of the world that there was a serious risk of a major pandemic from a new pathogen in the very short period of time, and governments should prepare for this. What did governments do? Absolutely nothing. Why? Because it costs money. They weren't prepared to cover for the risk of these pandemics, so their health systems, weak as they were actually at 99% level of capacity anyway. They didn't have the intensive care units, the nurses, the health, the things you need to have a robust health system, protect yourself from a new event, a shock, if you like, health shock, which you weren't able to cope. It's not the normal thing. We see the excess deaths for COVID is way higher than the normal thing. They didn't have the capacity for that. And on the other hand, nothing had been done to do research into providing vaccines against the danger of these viruses. The SARS virus, of which COVID is one, has been around for the last 30 years. We know about this virus. It takes a new mutation. You can have vaccines to cover this well in advance. Now everybody's rushing to get a vaccine, but the pharmaceutical companies have done nothing about it. Of the 19 US pharmaceutical companies in the US, 16 of them do no research on vaccines whatsoever. They're much more interested in diabetes, obesity drugs, depression drugs, drugs for your potency, things that they can make money out of, rather than trying to find vaccines for the poor people of the world or to deal with this pandemic. So in that sense, you're absolutely right, Marcelo. This was not a shock. It was coming. It's just that governments, nearly all governments, not all governments, one or two governments were ready for this because they'd had experience in Asia of SARS before, so Korea, Taiwan, and so on, were more or less equipped to handle this, but nearly other governments weren't. And so that is why we've had the lockdowns, because if governments had had robust health systems, if they had had preparation for the pandemics, probably we could have avoided mass lockdowns. That's the thing about it. But people, I hear libertarians saying, well, the lockdowns, it's destroying the economy. We need to get back to work. We need to open up again. We need to, that's just breathe the virus out. I think your president takes that sort of line that, you know, I'm strong enough. The coronavirus is just a fear of the virus. There's nothing wrong with it. But that argument is based on the view, which it has a tiny element of truth in that if you had robust health systems, if you'd had vaccines prepared, if you'd been ready for what had been told was going to happen, then you could have dealt with it. In fact, once we got the lockdowns and the containment and the social distancing, and then they had massive spending on the health system, which they've been doing for the last 3 months, try and build it up, then you can contain it. If you assume that there's a 1% death rates for this virus, nobody's sure exactly what the death rate is, but it's anything between 0.5% and 1% at the moment, which is, by the way, 6 to 10 times more than the annual influenza virus death rate. But if you had that and no containment, millions of people would have died. But through containment and lockdowns, you have kept it down to only 600,000 at the moment, which is an indication of if you've been prepared, then it wouldn't have been a shock. So that's a long answer to the question of shock.
Let me ask you a question. I will change a little bit of the subject. I'd like to ask about the European Union. What will be the future of European Union after the Brexit and the pandemic? Do you see a future for the European Union and the contradictions within the European Union? What do you have to say about that?
Well, just this weekend, the European leaders have been meeting to discuss a recovery fund for the pandemic. And that fund, for the very first time, is supposedly going to be a huge fund which everybody participates in the European Union in order to help out the countries that have suffered the most, Italy, Spain, or the countries that are the weakest, like Greece and Portugal and so on, with funding which has mutually been financed by the rest of the European Union. But as of this morning, there still had not been agreement on this deal because the northern European countries, Holland, Denmark, Sweden, others, are opposed to having a fund which basically means that they're transferring their tax revenues and their borrowing. The borrowing will be done by the European Commission. They'll be under control directly to the south, and they'll have no control over that. The way in which monies are transferred in the European Union up to now has simply been a very, very small European Union budget, about 1% of European Union GDP, when most budgets in the world are something like 30, 40% of GDP. So there is no fiscal harmonization or union in the European Union. And this plan would imply some sort of fiscal mutual fund, which would add something like 1% more to the mutual part of the European Union budget. And that is being fought viciously by the Northern European economies because they don't want to do that. Because their image is that what the European Union is for trade, is for capital flows, so the richer, more efficient economies can put their capital into the south to exploit the workers in the weaker countries and transfer value into them, and therefore gain a bigger market for that. And the smaller countries are in there because if they're on their own, it will be a disaster. They can't manage on their own, so they've joined the European Union with the hope of getting a share of the general growth that comes from the expansion of trade and finance in this bloc. And let's be clear, it has been a certain success. The European Union, from when it was formed, say, in the 1980s onwards, as a trade and financial bloc, did expand productivity even for the weaker economies. But the euro, which came in at the beginning of this century, has restricted the ability of the weaker economies to perhaps take advantage through devaluation of their own currencies to improve their position. So that strengthened the grip of the stronger economies and led to an uneven development in the European Union. And in the Great Recession, that really, those fault lines were exposed sharply and leading to what was called the Euro debt crisis in 2012, when countries like Greece, Portugal, and others went into a severe depression, couldn't pay their debts, and they had to be bailed out under the most stringent austerity conditions, which have left, in the case of Greece, Greece now has a public sector debt of 180% of GDP, which will not go to the European target level of 60% for the rest of this century. They will never get that back. So the Greeks will be paying back interest on this debt, mainly to European Union institutions, for the rest of the century. That's how severe the measures have been introduced. Those debts have not been cancelled. So the pressure, the stresses within the European Union will be raised by the COVID pandemic slump as well. And now, of course, it's been increased by the example of Britain leaving the European Union narrowly, as far as the population is concerned. But obviously, this doesn't really affect what goes on in the euro currency, perhaps, in my view, except as an example, which might be offered to people countries who feel they should go on their own. Britain, of course, thinks it's so powerful that it doesn't need the European Union, or at least a section of the capitalist class there does, and that they'd be much better under the kindly and relaxed wing of Donald Trump than under the harsh and cruel rule of Mrs. Merkel. So this view that the British have, I don't think is a very good example for the likes of Hungary or Poland or Bulgaria or Greece as an alternative to go on their own way, because they're not in that position to do so. And I think, I tell you, the figures show that Britain's Brexit decision means it will lose something like 4 to 6% of GDP on a cumulative basis over the next 10 years. Not as severe as a COVID stop, but still a real damage to the British capitalist economy. I think the COVID crisis is increasing the stresses of the European Union. It's most likely, unless we have a severe slump that lasts for several years, that the European Union leaders will prefer, that means the northern countries, will prefer to keep it together rather than throw out the countries that are weak, because they need the general advantages they get from the Union and from the Euro. I'll finish on this point, Adalmir. The European Union and the Euro will break up only if Germany and France want it to break up. If they wanted to break up and the northern economies wanted to break up, then it will. The southern economies won't leave the European Union and the Euro because they have no alternative. They just have to take it. They're a bit like, how can I put it? They're employees without a union, and so they're stuck where they are. They have to get what crumbs they can off the table.
Alessandro, join us.
Yes, Michael, I want to ask you a question from our viewers.
Yeah.
There's a question from one of our postgraduate students, Mateus. Mateus asks us about the changes in the way the labor is working, is doing in the pandemic. It's this change of the way the labor is served to the capitalists will improve or made a major increment in the profit rates. The question is about something that we are asking. We are talking before the transmission about this change of working place or working environment with people working at homes, and this making possible for the enterprises to make more profits after the pandemic. What are your thoughts about that, please?
Well, it's I think we're going to have to discuss this for some time ahead, because it's still unclear how it will span. What I can see so far, that home working for knowledge workers has been greeted by the bosses of the companies that have put their workers back at home to work, after the shock of the slump, have been greeted quite well. They suddenly see that maybe this is a way in which they can increase the productivity of their workforce without having to pay for it. Workers at home, perhaps spending on their own electricity and so on, can work longer hours, hopefully, around the computer. Home working, research studies show that home working does lead actually to more hours being put in by people at home, because they work at different hours on all sides. And that way you can improve the productivity. Also, the big companies are thinking now about closing down physical offices and other expensive things that they have to do when people have to go physically into work. They can reduce their fixed capital costs quite significantly. That presumably will help with profitability as well as a result of that. So on that hand, it would seem that this would actually help capitalism. We've seen improvement in profitability by getting knowledge workers at home to work more productively and reducing fixed capital costs. On the other hand, studies also show that actually productivity and ideas and success for companies are often better done when the workers are physically together, working in teams. Teams seem to be very successful, where they can generate and throw ideas around. Home working is not so good as that, despite Zoom meetings, and this one's an example. I'm sure that we'd be much better off if we were in a room together where we can argue the toss rather than through the screens. So it doesn't always produce the result they want. Also, companies, bosses are not sure what home workers are up to. They're not under the same sort of control they are when they're physically at work. But nevertheless, I think there are two aspects to this then, that we're still not sure how that's going to work out. The other side is workers who cannot work at home, who physically have to go, whether it's they are travel workers, drivers, and so on, in transport and so on, or whether it's in manufacturing. What's going to happen with them? Well, a lot of them have been working during this pandemic, and they've been under severe risk. As we know, the frontline workers and so on, the health workers and care workers and manufacturing workers, transport workers, all of these people are not home workers. They can't be home workers, at least not on the whole. Maybe that will increase. It's possible in certain areas that could be the case. But these workers are going to have found it quite difficult. But yet there's, I think what capitalist companies will be looking at is to robot these workers out, to reduce the amount of workers they need to do these things, whether it's driverless trains, whether it's robots in the manufacturing factory, whether it's sending health workers home to do things over online, on TV with their patients and so on. Maybe those areas are going to expand a lot more as they try to find ways in which they can save on labor costs over the next period. So how much of that's going to be done and how effective it will be in driving up the profitability and increasing the exploitation of the remaining workforce, I'm still unsure of. I think everybody should be thinking about this though, and see we need more work on this to see how this is going to pan out. The other aspect finally is that, which is better? If workers are at home, they're atomized. It's difficult for us to talk to each other about things that are wrong with the bosses, with the company and so on, unless we're close together on a regular basis. Maybe you could do that through social media and so on, which has happened in the past. But these are other issues too. So what's the nature of the class struggle going to be between workers and their bosses as a result of the expansion of this sort of a Zoom in our world over the next period, which clearly there's going to be.
Okay. Marcelo, do you have another question for Michael?
Yeah, I have a lot of questions, so perhaps I'll have to talk to Michael private later. So it was a very interesting presentation. So we got a lot of questions here. So I have a short one and a longer one. Oh, the shorter one is, have you ever considered changing the name of your blog to The Next Depression?
Well, yes, subject to the machinations of the cloud, I could probably do that. We're in the next depression already, so I didn't really want that name of the blog. It's the only one I could get hold of. I would have preferred something a little bit more straightforward. Yeah, but I see your point. One of the main things that I've argued, as I said in the presentation, is that we're not in a normal recession. We weren't in a normal recession after the Great Recession in 2008-9, when I wrote a book called The Great Recession, Marxist View, which was a series of articles prior to the Great Recession, where I argued we were heading for a Great Recession. A few people have claimed that they saw the Great Recession coming. I would like to be part of those claimants. That I argued at the end of 2005 that given the nature of where profits were going and where debt was going, I'm often accused of ignoring debt. Actually, I spend a lot of time thinking about it in my work. And so those two factors coming together suggested to me that and also the nature of the long cycle as I saw it, that we were heading for a big slump in 2009-10, I think I said in the Great Recession. I was wrong because it came a year earlier. Since then, I expected in this long depression that it would come to an end after 7 or 8 years, which is the normal period of capitalist booms and slumps at the moment. So that put it at around about 2015-16, and I kept getting it wrong every year. So I kept keeping to the next recession. Here we got, I made a presentation, I think last year before COVID, to a socialist group, which I said, next year, if I come back having predicted a recession for the last 3 years and we don't have one, then you'll be able to take me off the podium, and that will be it. Luckily for me, COVID came, so we will never know whether there would have been a slump anyway, although I did argue in my presentation, I thought there would likely be a recession in 2020 anyway, given all the factors coming together. But it's certainly been delayed. So this depressionary period, we have to analyze why it's been such a long one, a weak one, but why it's been such a long one. And you can characterize it as more of a depression than a recession.
So the longer question is about fiscal and monetary policies. And then it seems that you have these big numbers. Okay, so if you look at the balance sheet of the Federal Reserve with assets reaching 50% of GDP, it's a huge, and then deficits, the numbers that you gave, the cumulative results, 25-30% of GDP is also huge. And then it seems that monetary and fiscal policies were not working before the pandemics.
Yeah.
Why would we expect fiscal and monetary policies to work on the pandemics?
Well, I don't think they will work in the sense of providing an economic recovery in terms of productive investment, GDP, incomes, and employment. My view has always been, if those who read my blog regularly and other things, I argue that capitalism has these booms and slumps. The way it gets out of booms and slumps is by restoring profitability, if it can do so, by the destruction of the fixed capital, or devaluation of the fixed capital, which is no longer efficient or useful, and by reducing the employment levels. That's the traditional way crises are ended under capitalism, in my view. I don't accept the Keynesian view that we could avoid crises by simply having government spending indefinitely, which is currently the position of modern monetary theory, which is something we can discuss another time, or that recoveries can be achieved and sustained through Keynesian fiscal and monetary stimulus. I always remind myself of what Keynes himself said when in 1932, with the depth of the slump in the Great Depression, the beginning of the Great Depression, with the depth, he said, we need to have much more monetary stimulus. It's not good enough just to reduce interest rates because of liquidity traps. We need to have unconventional methods. We need quantitative expansion of money. Governments should think of buying bonds. Where have we heard that before? That's what we hear now. So Keynes advocated that 32, 33. By the time he got to the general theory and publishing it in 36, he said monetary policy has failed. It doesn't work. All that's happened is it's just been hoarded by the speculators and the capitalists, and they're holding the money. They're not expanding it into the productive sectors. So the government has to intervene. We need government spending of massive proportions to run a deficit in order to achieve that. To some extent, the Roosevelt government tried to do that, although really it didn't expand fiscal spending much. It introduced work programs and so on, and that was to some extent. But as I take you forward again now to 1944, and Keynes says, well, what's been proven by this is, unless you have a war economy where you spend 25 or 40% of GDP, the government does that directly through contracts and so on, not welfare benefits, but actually the productive sectors of the economy. Unless 25, 40% is led by the government and spent by it, you can't turn these capitalist economies around. So he said, I have to admit that only a war economy works for Keynesianism. Well, yes, because the war economy actually didn't do Keynesianism. It replaced capitalism. The military economy replaced capitalism and did it directly and organized it that way. And this applies to the pandemic. Unless there was, I wouldn't call it a war economy now, unless we have a social economy where the government leads investment, controls the productive sectors of the economy and makes the contracts work, moves the economy forward, employs people on work programs in the productive areas, in the environmental areas, then recovery will not be achieved. Of course, eventually there'll be some sort of recovery, but this massive fiscal spending is not going to achieve that. And it's also short term. It seems big, but the governments don't want to spend this in 2021 or 2022 or 2023. They're doing this because they think COVID will be over by the end of this year, and then they can move back to return to normal. But there will be no return to normal this time.
Thank you.
Alessandro has another question.
Michael, I want to ask you about the US elections this year. And I would like to hear your thoughts about the both possibilities, new Trump administration or the election of Joe Biden. What are your thoughts about these different possibilities and the probably outcomes of this election for the United States economy and the world economy?
Well, as you know, the polls are showing that Donald Trump is in real trouble, that he's probably got his lowest popularity levels he's had since he's been in office, that in virtually all the states, the 50 states, Joe Biden, the Democrat candidate, is leading by anything between 5 to 10 percentage points. I saw figures to show that Trump was unlikely to win more than maybe 2 states. Most importantly, he wouldn't win the big 4 or 5, which matter in order to get into the presidency. So as of 4 months to go, I think it is, it would appear that Biden will win this election. Now, maybe that will change, but I think it seems that the failure of Trump to control the COVID pandemic in the US, apart from his madness, I mean, let's leave that aside, his failure to control the pandemic, which means that lockdowns keep coming on and people can't get their incomes and work back. And especially if all the special programs to keep incomes up for people, whether they're furloughed or otherwise, come to an end, which they will do in the next month or so for everybody, unless they have a new extension, which means more money, then there's going to be a serious rise in unemployment, which without people not backed up, that's going to increase disappointment or opposition to Trump. It's clear that Trump has 30% of Americans who are going to vote, whatever happens, because as far as they're concerned, what they want is some sort of nasty world where apparently you can do what you want and it doesn't matter what the rest of society thinks. But the vast majority of those who are going to vote, as of there now, seem to be going to go vote and vote for Biden. There's no other candidates. I don't see any other likely candidate to get on the ballot paper that makes any difference. So we will have, most likely, unless things change, a Democrat president in November, and we will have probably Democrat majorities in the 2 parts of the Congress, the House of Representatives and the Senate. So for the first time, for a long time, there'll be a president who has a majority support in the Congress as well. Now, there's one issue here. Will Trump accept his defeat? Some people are saying that he might actually organize a coup or something. Well, I don't think that's very likely. What he will not organize, though, is probably lots of demonstrations and rallies against the decision, claiming it's fake news, claiming it's illegal, claiming them of irregularities, etc., etc. If it's a big enough victory, I don't think that's going to be sufficient. So we could end up in January 2021, probably with the COVID pandemic still with us in the US and a severely depressed economy with high unemployment, with Joe Biden in the office of presidency. I can't see what Joe Biden's going to do any different, really, than what Trump has done, except obviously slightly more sane, if almost senile, apparently. So we have a new president who will have a different attitude towards the pandemic, a more sensible one. He'll take health advice, but we still have an economy which can't be resolved. And he'll probably have a slightly less aggressive manner towards the allies internationally, although the position of the Democrats is just as aggressive on China as Trump is. So I see no particular change there. So in many ways, a Biden presidency is going to be a continuation of the nightmare which the US imperialist economy seems to be entering at the moment and could continue.
Let's do the following. I will ask one question, then Marcelo ask another question, then we could end the talk. It's great for us, we could keep going, but it's getting late in England.
Yes, that's right. The stomach is okay.
Yes. You almost answered the question that I had, is that I'd like to ask about the Chinese way of organizing the economy. If the post-pandemic era, some countries will adopt a more Chinese way of organizing the economy with on public enterprise and public investment. Perhaps it will be one way out of the crisis.
Yes, I agree with you, Adalmir. I think that now this is a big debate amongst socialists about what the nature of the Chinese economy is, as you know, or the Chinese state. The vast majority, I would say, of socialists and Marxists agree with the bourgeois that China is a capitalist state, or at least the bourgeois academics. Obviously, the bourgeois politicians say it's a horrible communist state. But the vast majority of Marxists and socialists think that China is a capitalist state like America or anywhere else. I'm not so sure that's a correct characterization of what's going on in China. Otherwise, we can't really explain why China has made such dramatic progress in taking 800 people out of poverty, of expanding its economy, industrializing, raising productivity, increasing its ability to become the manufacturing center of the world and trade center, and now increasing the technology rival to the US, which frightens the US to death, which is why they're trying to block China. And it can only mean that in some way that economy operates on a different basis than a straightforward capitalist expansion for profitability and investment only for profitability. Yes, there's a private sector in China which is large, and yes, it does operate on the basis of profitability. We can even measure the rate of profit in China. But there's a very large section of the economy which is under direct control of the state, owned by the state, controlled by the state. This state is not democratic. This state is not a workers' state in the sense of being a democratic one. It's a bureaucratic run by an elite who take their privileges from it. But it also is run on the basis of state direction in order to drive the economy forward through a range of planning and controls. And that makes it different from just about any other economy, and explains, in my view, why its growth rate is so hugely different from, say, India, which only has a brief period of rise, or countries like Brazil. Why isn't Brazil doing as well as China? I think you argued in our interview we did some time ago, is that when Brazil did have a state-directed sector, which had some influence over investment, then they did have a relatively better growth rate. It's only when that was all done away with in the neoliberal reforms and the privatization of the Brazilian economy that Brazil has been unable to withstand the collapse in the crisis of capitalism globally and has gone down a production hole or an investment hole in the recent period. China is different. So in my view, that's one reason why they got out of the COVID quickly. The COVID started there, but they were able to impose the most draconian lockdown. No other country could impose that on the population, which the Chinese state did. They could do so, actually with the support of most Chinese people. And they were also able to come out of that COVID quickly with the expansion of state investment in infrastructure. Just looking at the figures today, actually, that the state sector has made a big jump forward in investment, while the private sector has continued to go down in capitalist style and has not recovered. So the state sector is a factor which enables the Chinese economy to come out of this COVID better than elsewhere. It's a frightening thought for US imperialism. They've got to do something about China. Why? China is the big enemy of imperialism now. It's got to be blocked. It's because it's a danger as another model, you might say, but also a danger to the share of profit that the imperialist powers can gain.
Marcelo?
One last question. I think that your throat must be sore by this time.
That's all right. I'll be having a few glasses, everybody, a bit later.
All right. So I have a question about these patterns of recovery that you have shown in your presentation. And then it seems that the trend is shifting, and it is shifting down. So we have lower and lower trend lines. So if we assume that, okay, the economy is going to resume a trend, but it's not the previous trend, it's a lower and lower trend, we are in a state of permanent depression. Don't you think so?
Well, it would appear so. I mean, we can look ahead and say, well, I argued in my book, The Long Depression, that depression would end when there was a sufficient destruction or devaluation of capital stock, so that the remaining companies that are left will be able to take advantage of lots of innovations which exist. During the Great Depression of the 30s, there were huge innovations taking place technology-wise. And after the Second World War, they all got implemented, partly through military activity, but also later on. And so there are lots of things underground. We know about them, actually. We're probably doing one now, that the new technology is there. If profitability was created to rise enough, then you could get a huge expansion. Perhaps you could have another period of recovery, a sustained recovery, or boom, if you like, for world capitalism. But each time, it seems to be more difficult. We're now into the 21st century. When I remember the 1970s period, when, of course, I was only a baby, then in that period, there was dramatic reduction in the profitability, which eventually led to a situation where there was a relative neoliberal recovery and so on. But now we seem to be locked in this depression where we can't get profitability up at all, and so we need severe slumps. So how can politically that be possible, really, for another huge slump in order to create the conditions for capitalist revival again? I don't know. Capitalism doesn't want to do it. They might have thought about it in the 30s, section of them, but they don't want to do it now because they just fear that that would produce situations that would be out of their control. And that's the real danger of trying to, as it were, liquidate the dead wood, liquidate unproductive workers, old, sick, unproductive, uneducated workers, liquidate them, put them on the unemployment thing and just use the profitable parts of the economy. Can they do that politically? I don't know. At the moment, they don't seem willing to go quite that far yet. But maybe that situation would arise. But I'll finish on this point, Marcelo. I think you're right. Each time we seem to be entering a lower trajectory. Isn't that a sign that actually capitalism is an old system that's not working properly anymore? And whenever it did, it's not producing the productive forces in the way that would meet not just social need, but even meet the needs of capitalism. It's a sign that capitalism is getting an old system. How old is it? Well, 17, 15, you could talk about maybe being, so we're talking about what, 250 years? Not long in human history, not long as a system compared to the feudal system, but things are much faster than they used to be. So this system is already reaching its limits, I think, in its ability to expand productive forces and improve the systems of the world. Finish on this point. Think of all the issues that it can't deal with. Climate change, major environmental damage. What is it? It doesn't know how to solve that problem. It can't solve it on the basis of the capitalist position. And maybe more pandemics. These are things which they think are existential, but we know are the result of what they've been doing for the last 250 years, and they have no solution for that. So maybe we'll be locked into this weak trajectory for some time ahead.
Thank you.
I'd like to thank you, Alessandro, Marcelo, and particularly I'd like to thank Michael for talking with us. We learn a lot. Now we have to listen to you again and to learn more. And it was great to have you here, Michael. And we hope to invite you in the future to talk again with us. It was great. And thanks a lot. And I hope all people in Brazil you look at our video, and you visit your blog, the next session. That is really great. Thanks a lot.
Thank you, Adalmir, and everybody else. Thank you.
Okay.
Thank you. Thank you. Bye-bye. Thank you.
Bye.
Thank you. Bye-bye.